Hey, party people, bringing you this week's money news in human words. And as always, there's a lot of stuff going on. The big one, though, to close out last week was this massive share market surge that we've been seeing off the back of the US inflation data. The NASDAQ was up over 7% in a day. That's happened less than 20 times in history and not for a couple of decades. And yeah, some really welcome news for investors. The S&P 500 was also up 5%, and then they both added another couple of percent to actually close out the week. Now, what this says to me is that there is a lot of money sitting on the sidelines, ready to pounce on the slightest sort of hint of good news that we're seeing. And yeah, that came together last week with the US inflation data. Came in at the slowest rate, still increasing, but slowest rate since January, giving investors and market participants some hope that the interest rate rises are working and that we should start seeing a slowdown to rate rises soon. What that then flows through to mean that the economic conditions don't necessarily need to be as bad as what was being predicted. And look, I think the overarching sort of lesson for me in this is that you never know what's going to happen. It's only a couple of weeks ago, people are saying, oh, it's inflation, massive, out of control. And obviously it is a huge problem, but people are saying when the forecasts are bad, people just think that they're going to get worse. It's like this polarization of thinking. And as soon as something changes, then bang, everyone sort of changes their tune. And we've already seen a number of economists and the big banks come out saying that they think that now rate rises won't need to be as high. They're rising down the peak interest rate forecast over the next little bit. All welcome news. It just goes to show how quickly those forecasts can turn around. As a result of the US numbers, though, the Aussie dollar is going off. It's up 76 cents from 62 cents just a month ago when I started talking about how the Aussie to US dollar was at this massive low and that there was a lot of opportunity there. That's coming together, although I think that there's probably still a bit of a ways to go there. It's again, the forecasters are talking about some more growth in the share market ahead of Thanksgiving over in the US, mainly as a result of people talking about some of these revisions downwards of the forecast. So I think for investors, could be some good news after what's been a choppy couple of months. Following on from that, looking closer to home at the Australian mortgage interest rates, and I was reading an interesting piece last week talking about how home loans are set to peak at 6.6% next year, which is a pretty staggering rate, and particularly thinking about how they've come from close to a couple of percent and even below a couple of percent just within the last 12 months or thereabout. So basically the forecast to the cash rate is set to be around 3.8%, but then when adding on the margins from the banks, then it's going to push the mortgage interest rate is somewhere around that 6.6%. Now, at the 3.85% cash rate, the monthly mortgage repayments on a 25-year, $500,000 mortgage have increased by $1,000 per month. So on $1 million mortgage, that's a couple of $1,000 a month. And that shows that there's potentially some more pain ahead. Like I said in the last piece as well, though, that these forecasts are changing all the time. A lot of people talking about from the banks come out just in the last week and they revised upwards the forecast with the Aussie inflation numbers. Now they're starting to revise them down as well. So Westpac and ANZ are both talking about they think that the cash rate is going to peak at 3.85%. NAB is forecasting 3.6%. Commonwealth Bank 3.1%. And so it is a real mixed bag and a lot of variability there. Fingers crossed, obviously, for mortgage holders and for property market participants that it comes in at the lower end of that forecast. But we are seeing some people like I saw Warren Hogan from Judo Bank came out and talked about a cash rate of 4.5%. So, I think we're all hoping that it won't get there. mainly for the impact on the economy. But it seems that the latest communications from the RBA suggested that they are potentially preparing to pause on their interest rate tightening. They're seeing the case reducing for more interest rate rises, and I think that the US data will probably play into this. So will be a very interesting board meeting in December to see if anything else comes in before Christmas. Talking property, and there are a couple of things over the last week. For first home buyers in New South Wales, stamp duty is now optional. Basically, these new rules kicked in on the 12th of November, saying that basically people can save up to 2 years of saving their property deposit by not paying the lump sum upfront stamp duty on $1 million property. What it means is a choice between paying $40,000, a bit over $40,000 upfront, or an annual fee of about $2,200. Was looking at some modeling from the AFR, and they showed that the payback period on stamp duty versus land tax over time. And yeah, I think it makes for some pretty interesting reading, because ultimately, of course, paying $2,000 in the next 12 months is going to be better than paying $40,000 tomorrow. But over time, because the land tax is every single year, and because the land tax increases as the value of a property increases over time, it means that you will end up paying more. But looking at the numbers, on an $800,000 apartment, the payback period is 36 years. So basically, you're better off for the first 36 years of that purchase by opting for the land tax as opposed to the upfront stamp duty, when you factor in the time value of money as well. And the higher you go with your property purchase price, the shorter that payback period is. So on $1 million property, 28 years is the payback. On a $1.25 million property, it's 26 years and reducing from there. But still, you're talking about a couple of decades. And in my view, if you're chasing your tail, watching the property market increase, trying to save up this massive chunk of money to fund your stamp duty, if it means that you're delaying getting into the property market could have then risen in value, and you are effectively chasing your tail. So I think it's a welcome news for first homeowners, and something that's worth really close consideration. No one right way, but running the numbers, I think, will be really, really valuable. The scheme is open now, so understand what it is and how it might work for you. Last piece on property, and I looked at this piece from the AFR talking about how the super rich buy property last week. They mentioned a bunch of high-flying, like high-profile CEOs and investors and how they buy property. And I was interested to see that basically all of these investors, the only properties that they're buying are premium suburbs, premium properties, blue chip areas. They're typically higher value properties, $2, $3, $4 million properties, calling out that at that sort of level or that value of property, it means that the rental income that you get from a property is going to be lower in percentage terms than what it would be on $1 million dollar property, or in something that's more reasonable range that's accessible for more investors. And what I mean by that is, if you bought one $5 million property and rented it out, you would get less rental income than buying five $1 million properties and renting it out. Even though you've got the same total amount of property, the income that you would get is more. But that being said, clearly they are comfortable, these investors, with the fact that they're going to get the growth on those properties over time. And they've certainly seen that. If you look at these areas, where they were, like a few of the areas quoted, Bondi, Wallara, North Bondi, Inner East, Redfern, Alexandria, and these areas that and looking back at what's happening in the property market, you can see that the growth has been really strong. I feel like there's a good lesson to take from that if you've got ultra rich people that switched on enough to get ultra rich in the first place, I suppose, and have good advisors and stuff around them, you assume that they're playing smart. And for me, it says that when you buy a property that way, you're cutting out a lot of the noise of the property market. You're not chasing the hotspots, and that means that you might not get that massive payday by picking the best performing property suburb. But if you've got something that's really good and you're playing the long game, you're going to get good results over time. Last piece for this week was on the FTX hack. And basically, for anyone that hasn't seen it, and it's been sort of everywhere, so be surprised if you hadn't. But basically, FTX is one of the world's largest and most respected crypto exchanges. They manage over $15 billion. They've gone into administration. Their 30-year-old founder topped the rich list in Australia, the Young Rich list, the AFR Young Rich list in Australia, and was touted as the world's richest young person, basically. But that place has been short-lived, and he's actually been removed from the list. Interestingly enough, excuse me. But basically, his wealth has dropped from $15 billion close to zero within 1 week. Now, that's obviously a sad story on a personal level, but the business side, which is also has impacted a lot of people, and a lot of investors in particular have been put out. But interesting to see how it's all come together. Basically, there's a few things at play here. Essentially, FTX is a crypto exchange, but they also issued their own crypto token called FTT. This gave holders access to fee discounts and perks, as well as the ability to participate in things like new coin launches. Basically, with FTX, you needed to hold a certain amount of these tokens to participate in new coin launches. And in fact, the FTX new coin launches on their platform, they're probably the best performing of any platform. They did really robust due diligence. They made sure that they only launched new projects. They were really selective with the investments that they put on there. And if you look at their performance, they were actually pretty incredible. And as I say, I haven't seen a better platform for that. So there was a lot of good things going on, but basically it's all sort of fallen apart. Now, what's sort of led to all of this, that Binance, and another massive crypto player, has long time been an investor in FTX through these FTT tokens. Basically, they made a decision to dump $500 million of FTT on the market, and referred to some of the developments at a related business called Alameda. I'll unpack that one in a little bit more detail, because that has led quite a lot to the trade. But basically, the boss of Binance mentioned to the market through Twitter, of course, that they were going to dump this stock, and then or stock in these tokens, and then basically there's a huge run on the platform after that. By Wednesday, Bankman-Fried, who's the head of FTX, has reached out to Binance and asked them if they'd be interested in buying or doing some sort of merger type deal, which they said that they would, on the condition of looking at the books. But then they looked at the books, and they eventually backed out of the deal. And at that point, basically the investors are sort of running from the hill. Now, they're running for the hills. Now, there was two main things that seem to have led to this, and one thing that's accelerated the decline. The first is his relationship with a company called Alameda, which is a related business where they do research and trading of crypto type investments. It seems as though there was some sort of sweetheart deals happening between the two platforms, which is obviously pretty dodgy and not on. And yeah, that's the big one that caused the Binance boss to back away from the deal. Now, what seems to have accelerated things is it looks like that, in addition, they may have been hacked on the platform, and a bunch of investors' money has gone missing. Now, this is really sad to see people losing money, and it talks to the fact that we really do need some better regulation around the crypto space, because there's essentially, like, with share type investments in Australia and managed funds, doesn't matter which provider you use, there's appropriate investor protections in place, such that if a company like CommSec or E-Trade or Pearl or Self-Wealth or Raise, if they go bust tomorrow, all investors' money is safe. You basically just need to find a new administrator, but it's not the same in the crypto land. So what that means is that there's no government backstop to stay the day. They don't have those protections in place. So for investors through FTX, basically their assets have been frozen, their employees are bailing, and everyone's just left scratching their head and stressed about the impact on the market. So it shows that there is still a bit of risk there. As I say, I think that we need some legislation to tighten things up and protect our investors. But ultimately, yeah, a lot of upset customers out there, and shows the heightened risk that can happen with digital assets and cryptocurrencies. Guys, that's it for me for this week. I'll catch you on the next one.